Hello, viewers. I'm back with an English series on investing in the times of Corona crisis. This time I have invited Léon Kirch, who I want to introduce you in a second. Before that, I would ask you to subscribe to my channel, leave a comment or like if you liked the video. Thank you. Hello, Léon.
Hello.
It's very nice to have you in our series on investing in times of Corona crisis. Your focus as an investor is the European stock market, or?
Yes, that's entirely correct. I've been applying the same investment philosophy on European equities since '98. And well, it's about value investing, stock picking in currently very difficult European markets.
But before we go into details with the markets, let's chat a bit how coronavirus changed your everyday life. You're located in Luxembourg. What happened there?
Yes. Well, we are a regulated asset management company. So currently, when Luxembourg declared the state of crisis, we moved all the stuff out of the office. And all the stuff is now currently in home office mode. So it's a different way of working. I believe also that in video calls, some of the communication is being lost. On the other hand, it gives us the opportunity to also in a different frame to think more and to try to take care of our investments. So it's I think it will profoundly change our working lives going forward, because now I think everybody discovers that home office also works, and it can become a part of our daily lives.
So let's dive into the investing side of our interview. Thanks for the remarks also. I want to open some slides you've prepared for our viewers.
Yes, in order to start and in order not to have any issues with my compliance officer working also from the home office, I start with a disclaimer of the presentation. Of course, this document, well, we are a regulated entity, and it should not be. Well, it's mainly meant for professional, qualified, and institutional investors. It's our views, and their risk, of course, to the equity markets. If you want the details of our disclaimer, you can also consult our website on www.ec.lu.
So let's jump into the presentation.
Yes, we will here directly dive into the portfolio impact and actions, because I think we are currently being bombarded by all kinds of comments from equity strategists having their own view on viruses, but I think at the end of the day, our real value add is on the stock picking part, and there I would like to share some of our current views with you today. So what has happened in our European portfolio? Here is data up to the 20th of April, so it's already 10 days old. We had a better week last week, but I think what I wanted to show here is that our portfolio has actually been falling with the European equity market. There was not really any place to hide for us. There was pretty much indiscriminate selling across all industries. I think when there were forced sellers in the market, of course, the mid and small caps have been more affected than the overall market, and also value has again done worse than the overall market. as valuations did not matter. Our portfolio is somewhere in between, but of course we are not very happy about this loss, at least this paper loss we are currently showing. Here are also some of the bottom contributors and its companies that have suffered over that time period. That since the peak of the market on the 19th of February till now the 20th or the 22nd, that was Sunday, of April. So Group 4S was down 58%, John Wood Group 65%, and Barwerk 41%, so on. Rolls-Royce lost half of its market cap. Fresenius, despite being in an area, hospitals, which is booming, of course, was down 40%, more than 40% over the period. And that has impacted our portfolio. But that's the real view. I think on the next slide we go a little bit more into detail what we have actually done till now during the crisis. The first very important thing we learned, and as I explained now, I'm in the investment industry since 1998, and I apply this investment process since 2002. I think in period of crisis, it's very important we are not becoming forced sellers, because the ones who need to raise cash are currently getting the prices which are offered by Mr. Market. So it's very important not to be in a position where we need to fire sale. On the contrary, what we wanted to be is, despite making, of course, sure that our companies are still in good shape, we wanted to become selective buyers, and I give a couple of examples of new companies that we have added in the portfolio since the beginning of the crisis. So we had, going into the crisis, some dry powder, not a lot, because we are equity investors, but we had on the date of the 20th, we still had 6% cash left in the portfolio. That's not an asset allocation decision. That's in order to have dry powder. Currently, it has decreased even further, and it all comes back to the famous quote that be greedy when others are fearful, and fearful when others are greedy. I think what we need to understand is that when we assess the value of a business, we look at the earning power of this business. We look at how much discretionary free cash flow this company can generate in a normal year. 2020 is not a normal year for any company. I believe everybody agrees on this. But the value of a business in our mindset is what is much more relevant is to see how much is this company going to generate in a normal year. If you take that approach, you change your viewpoint towards the companies, because then you are not trying to look at how much earnings a company is going to make or losses it's going to make in 2020, which is, in my opinion, a very difficult debate. It's very hard to see. It depends on the length of the crisis. It depends on the measures being taken by governments and central banks. But what's much more important in our viewpoint is to be invested in companies who survive the crisis. And we are convinced that the companies we have currently in the portfolio will survive this crisis. And here I made a very simple analysis. So I'm actually cutting the sales by roughly 25%. So I'm of my median company in the portfolio. So you see that sales are going down from 100 to 75. As a rough assumption, I assume that gross margin will stay the same. Why? Because the companies need less goods to produce, less raw materials, etc. I also believe that companies will, on average, be able to adapt and cut their costs, and that's already currently ongoing. Sometimes it's not socially so accepted. You saw in Germany, for example, some of the big retailers refusing to pay rents. I'm not sure they can get through with that, but that's a difficult.
They have to pay it later. Like the retailers like Adidas and others, they have to pay the rent later. It's just,
but it's really, but also I believe Deichmann and some of the other ones. I think it just shows that every company now wants to preserve as much cash as possible to survive the crisis. And so here in my assumption, what I'm just looking at, how would the net debt to EBITDA vary under these assumptions this year? And actually, my median company in the portfolio, my average company, it took it 1.46 or 1.5 years to pay back down its debt in terms of EBITDA before the crisis. That is for my company, my companies or our companies in the portfolio have the level of the average European company, which is around three years. So, and under Corona, that or after the impact of the virus, it would increase to 2.25. So it means that it would take a little bit more it would take 2 years and a quarter to pay down its debt on average. So that is still below the 3 times which were kind of being used before the crisis. So we believe that this is definitely one example to show that our companies are generally in pretty good shape. However, what we are currently doing, we take company by company, of course, to get a more granular view. Till now, we have not had any situations where we think that a company will be stressed, a company we currently have in the portfolio. But of course, it's a very challenging environment.
What happens in the companies? That's quite interesting to see on this slide, I hope.
Yeah, I gave here some examples of what companies have announced in order as adaptations in order to weather the storm. And here it goes, here I summed it up, but that's general knowledge as what can be done in reduction of CapEx, so capital expenditure. Here's the example of Boss. Gives suspending store renovations, suspending new openings, less inventory inflow, in other words, produce less clothes, suspension of dividend or buybacks. That has become a general fashion, I believe, right now. We have many companies announcing that they suspend their dividends. It's even for banks. There has been on a European level an incentive, or a strong recommendation not to announce any high dividends or share buyback. I think your Minister of Economy, Ms. Altmaier, summarized it by saying if I recall correctly, in 2008, banks were part of the problem. Now they should be part of the solution. And so it's not en vogue to pay out high dividends. Here I took the example of a chocolate producer and candy producer, Cloetta. They probably, they are a little less impacted because I would suspect that if you are in your home office, you eat more chocolate than sweets. But on the other hand, they withdraw the proposal for the dividend. Once the crisis is over, these companies will come back. Another
Do you see further drops in the stock price in your portfolio companies if they announce that they won't pay a dividend?
It depends. Generally, it's well taken as a measure. But for some banks, like the German BAWAG, the Austrian BAWAG, once they announced that they are suspending also the dividend, the company was previously on a dividend yield of around 10%, which is, of course, very high. It was not taken so well by the stock market, and stock price dropped further. I don't think we can hold it against the companies to suspend the dividends and to hoard their cash in light of the uncertainties we currently have. But it also means that for investors who just focus on the dividend yield when they invest in a company, that can probably lead to some disappointments because these dividends will probably be cut.
Interesting.
Then, of course, we discussed both previously, both simply did it. Adidas did it. They didn't announce anything, but it became clear that they wouldn't want to pay their rents. That was these rent holidays from landlord. Here I gave the example of Superdry, but also the negotiation with the lenders that is going on consistently. There are more drawdowns on existing facilities. Even companies who have strong balance sheets tend now to try to hoard some cash. General reduction in costs. Here I gave the example of a company I will present a little bit more in detail, Applus. What they have been communicating to the market, and then withdrawing the guidance. I gave the example of ISS, but I could mention most of the portfolio companies we currently have. It's really an environment where nobody wants to guide precisely. To illustrate the opportunities that we have currently at hand, we are using at ECP a screening to attract our attention to potential investment candidates. And here it's an example of the repartition of price earnings before the crisis and after the fall in stock prices. So you have the first column, two columns is PEs below 5. And then from 5 to 10 times earnings, from 10 to 15, from 15 to 20. And the blue is before the crisis and the orange is after the crisis. So the median PE in our universe, and that's ex-financials, of 1,418 companies has decreased from 17 times earnings to around 11 times. That's the first thing. And then if you look at the repartition, you have now a good chunk of your universe that has a PE below 10. Of course, these earnings will be revised downwards and are currently being asked by analysts. But again, if you think that 2020 is an exceptional year, and 2021 will look again as in terms of earnings as it was forecast to be 2020 last year. You have before the crisis, you have in my opinion, quite an interesting opportunity set currently.
So let's get into details.
Let's well, here I give the example of several companies we have added to the portfolio. So the Applus is a Spanish company. It's actually active in testing, but also inspection and certification services. For example, for cars. To stay in service, they have a part of their business which is also linked to the energy, to oil and gas. And however, they have a good part of their business, 40% of the earnings, they come from this multi-year vehicle inspection, and there they have very long-term contracts, and there is no major contract renewal before 2022. So I think you still have a lot of visibility on their earnings. This company has lost, as an example, has lost from the 19th of February till the 20th of March, has lost 60% of its market cap. And on these earnings that will be revised downwards still, but which are good indication of what the real earning power longer term of the company is on 5.2 times. Another example is Philips, because something we tend to look at is there are some companies we wanted always to own, but we could not access them for valuation reasons. And Philips has now become is interesting to us because from a conglomerate, it has slowly and more evolved into a pure healthcare technology company. They are market leader in imaging technologies. I think that they have really good growth opportunities also going forward. Another example is Elekta. Elekta is a company we previously had in our portfolio, but we sold it roughly 2 years ago when the company had reached our fair value. The stock had fallen in a month 41%, and it's still, in our opinion, an excellent business. This is the price earning estimated now for they have for the fiscal year that is now starting in April 2020. You suddenly get the global leader in cancer treatment via radiation therapy at a very accessible price. And while hospitals for the moment, of course, are not thinking of investing into linear accelerators or brain surgery via radiation therapy like the laser gamma knives they have, these themes are still around once the virus is behind us. And we would expect that a company like Elekta has not lost its competitive position in that period. So for us, it's an opportunity.
Like the valuation ratios, this is the PE ratio, the upper one, and it's the dividend yield below.
That's right. That's right. It's just to give you a feeling on the valuation. Of course, we have we build models on the individual companies, and we value them on the base of earning power. So this is just to illustrate a little bit what is going on. And Exor, well, is a holding company, an Italian holding company. some people consider the CEO of that business, who apparently, who has an excellent track record as a capital allocator, as the Warren Buffett of Europe. Exor is the main shareholder in Ferrari, and CNH Industrials, Fiat Chrysler. The company has what I find very interesting. So actually, when we looked on the 20th of 10 days ago, the share price was around 36 euros. You have 23 euros in cash. So there is value in these businesses, and these businesses will survive. And it's for us also a good way to access companies like Ferrari at really a depressed valuation. And then Adidas now, of course, is due to the rent discussion a little bit more controversial in Germany.
Surely, yeah.
But I think that overall, the work the CEO has done in bringing up the margins of that company's direction, the ones Nike has, having a product portfolio that is again amongst or in fashion with the younger generation. We believe that having this stock price falling 40% gives us again an opportunity. But you see that it still has a price. It's still on 20 times earnings. But we would think that these type of businesses will rebound strongly once we have left the crisis behind us. Yeah, here is a little bit my conclusion. When I look at my current portfolio, here we managed together at ECP as a team. The current portfolio has a margin of safety of 52%. That is something, well, what does this mean? For each individual company, we assess what our fair value is, and we compute the discount of the current stock price compared to the fair value. That's the margin of safety. And this margin of safety has two roles. It's a safety net, of course, against our mistakes when we try to value business, but it's also our source of return, because why are we assessing the earning power and the fair value? It's in order to generate a return and to see that margin of safety to close. And but a margin, and we typically invest once the margin of safety is higher than 40%. That's the start of an investing. Now, as a weighted margin of safety of 52%, that's probably the highest I've seen since I'm applying this investment philosophy. So there can be two conclusions from this. Either you believe that the earning power of these businesses is terminally in and will be these companies will not survive, or you have, in our opinion, in our world, and that's what we believe, you have a valuation opportunity here. Nobody talks for the moment about valuation, but I think we have a current portfolio for the current year before revision downwards of the earnings, of course, of 10 times earnings, EV to EBITDA 6.88 times, dividend yield 5.13. But don't believe now this dividend yield will stay the same. Here's the sector allocation of our portfolio as of the 20s. You see that, I think what is quite often a criticism towards value investors is that we would go too deeply into energy stocks, into banks, into deep cyclicals. And if you look at our portfolio, we are we still have 14% in healthcare. These are companies like Sanofi, even Novo Nordisk, like Fresenius, and Elekta, I mentioned before. But we also have consumer staples where we have companies like Reckitt Benckiser, like Danone, but also like Ontex, which is a diaper maker in Belgium.
I think on the next page we will see.
Yes, and here you have the top 10 allocations. I think part of this allocation is also the fact that some of the stock prices of if I'm very transparent, the large caps, some of the large caps have kept up higher or better than some of the small mid caps. So you see quite a concentration there in large cap names. But it gives you also an impression that a value investor does not only go into the dark corners of the market. We of course look at valuation opportunities in the energy sector. We have companies like Wood Group, Subsea, Técnicas Reunidas. But on the other hand, we also have more stable businesses. This is our current portfolio. So as we are long, we can also talk about our current investments. We feel comfortable with that, with our portfolio. What we are doing in our home office is, of course, we look for new investment opportunities, but we also want to make sure if we can get better quality names at even better quality names at decent valuations, then we would be able to maybe look at upgrade even the quality of the overall portfolio. But we feel quite comfortable with the portfolio as it is. Of course, an environment like this where you lose more than a third of the value of the portfolio in a month's time is tough. We didn't see major redemptions in the fund. On the contrary, we feel that family offices or bigger investors, they start to think on the after crisis and on the opportunities which are there now.
Like maybe let's go into two of the stocks you currently have in your portfolio. How do you see things at Fresenius? The stock fell heavily. Maybe you have a theory why and what's up in the company, and maybe also Rolls-Royce. But let's start with Fresenius first.
Okay. Well, I think Fresenius, as we know, has two main parts of the business. One is being a hospital operator, and the other one is dialysis. And of course, we see a strain we currently have on the healthcare systems. For example, Fresenius has an activity in Spain. So they have hospitals there. At one stage during the crisis now, there was rumor that the Spanish state would nationalize some of the hospitals because to improve the level of care, but that was only probably a rumor, and we would think that's pretty improbable. I have honestly not really an idea why Fresenius was particularly hit. I think there was a flight to perceived quality and non-controversial names. I think Fresenius is also a story where the company still needs to prove that it can achieve its targets, and but valuation is of course very interesting. But I think many investors prefer to be in a Nestlé at whatever valuation, not to compare Nestlé and Fresenius. There was not really, in our opinion, any reason why now Fresenius would be particularly hit. On the contrary, hospitals and the hospital operator probably will get more financing and more and government spending in the healthcare system if this crisis has shown anything needs to increase. And so from that perspective, we are quite positive still on, we are positive on the company.
And Rolls-Royce is discussed in value investor circles as an interesting opportunity because they get the cash flows from the airlines and the maintenance cash flows for the turbines. What is your take on Rolls-Royce currently?
Yeah, well, Rolls-Royce is, of course, now in a more difficult situation because first, the airlines are not flying, so they are not, usually you have a certain amount of payment per hour of service of a plane. And so that's on the one hand. And on the other hand, you have less. Of course, as the airlines now are in a difficult situation, that may have an impact on their capex plans for new planes. So there's a little bit of fire on both sides. If your biggest clients, which are the airlines, are in a very difficult financial situation, of course, we should be all aware that Rolls-Royce is impacted. However, I would say different things. I'm very confident that people will, the consumer will need and business people will continue to fly. Because it's very important for this globalization. There's an impact on it, but it will not go completely in reverse. I believe that therefore you need planes, and then you also need engines from Rolls-Royce. So the company is impacted. We are in contact with the company, and as late as yesterday, we had an exchange with the company to make sure that, we need to make sure that the company doesn't run into any liquidity issues, but apparently that's not the case. They have a lot of prepayments from their clients, but on orders. But of course, that is not money they can use to continue their debt is being downgraded, or at least there's being discussion on downgrading the debt. So it's difficult for Rolls-Royce. However, once the dust settles and the planes fly again, we still believe that the investment case is entirely valid.
So the longer it takes, the more risk is there for Rolls-Royce.
Of course.
So let's use it as a final word for the presentation here.
Yeah, the first thing is that I strongly believe, from my perspective, and at least if I look financially, and the world is not going to go under. And I also believe that our portfolio companies will come out stronger of this crisis, because they are not in an emergency. These are not zombie companies. These are companies that will survive, and therefore we are more careful buyers than stressful sellers. However, of course, it's painful, and we are very humble about the fact that our portfolio has also suffered. So we are positive.
Then thank you very much for the presentation and your insights and your openness. For the end of our interview, do you want to add something we haven't discussed?
No, I think well, this is our view currently. It's of course a dynamic situation, a very challenging situation. But till now, we still believe that this is the right way to invest, and this has not now changed due to COVID-19.
Thank you very much. Stay healthy, and I hope we text soon again.
Yeah, stay healthy too, and well, bye from the home office.
Bye.